Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenevec on Bloomberg Radio.
The blow landed late Friday. It was during our program, Bloomberg Businessweek.
Were you shocked a little
Daily.
bit?
I was shocked, yeah.
Okay.
Yeah, I mean, it was late in our show. It was close to 5 o'clock. We knew that, this would be a big story over the weekend and on Monday.
Yeah.
The big question is what would happen to the bond market. This we're talking about is Moody's ratings, revealing that it had run out of patience and was lowering its credit score on the world's biggest borrower below the top AAA level. Moody cited a years-long pattern of rising debt and budget deficits, which show no sign of abating and deeply rooted political polarization. We got with us Michael McKenzie. He's Bloomberg News rates reporter. He joins us here in the Bloomberg Interactive Brokers studio. I was watching what was happening with the 30-year, where it went above 5% today.
Yep. It's come back.
It's come back, yeah.
So someone was buying it.
Yeah.
But someone bought the dip.
Yields are actually down now.
Yeah.
I'm a little confused. Can you help us out?
Well, the 30-year has been rising for quite a while now. So it's essentially back to levels that we saw in 2023. That was in the aftermath when Fitch had downgraded the US. And then, of course, it was late 2023 when Moody's put the rating on watch, and they've now followed through. So from that point of view, it's not a surprise. I think what's happening here is the biggest story is the budget reconciliation process that's currently going through Congress has unnerved a lot of bond investors. So I was already working on a story a couple of weeks ago, talking to some big investors about this. And what you were hearing from people was none of these spending cuts they're talking about are earmarked. So the bond market's going to look through that. So Moody's managed to just push yields up a little bit more. So we opened up this morning above 5% in 30s. We've come back down, but we're still at elevated levels. And really the issue you're seeing here with the Treasury market is the US this year it's going to be having to refinance or roll over about $8 trillion of debt. The budget deficit's around $2.5 trillion. And this is where Moody's has said, what Moody's told us, we already knew. But what Moody's also painted is a picture that's pretty disturbing. And it's one that's sort of what the Congressional Budget Office also has been saying. If you look out 10 years, this is not going to get any better. In fact, it's going to get worse. The US is now already in a position where its interest rate cost of servicing the interest rate cost is bigger than the defense budget. It's going to become bigger than Social Security. It's going to become the biggest element. And so you essentially say, if you look at the US economy today, about 18% of its revenues are going towards paying interest rate cost. And that's why rates being above 4% across the curve is so damaging for the US.
So, folks will say, listen, we've talked about the problem of the US deficit years ago. It was in every conversation, then it kind of seemed to go away. And we just see it getting bigger and bigger. Others will also say, hey, listen, where else are you going to go? I mean, the size of the U.S. Treasury market, the liquidity that it offers investors. So where else are you really, really going to go? So there's that argument. So are they right, Michael? Like, I do wonder, is there some point where the deficit gets so big, it's going to be problematic for U.S. citizens, right, who aren't going to get certain services? They're going to maybe. Like, is there some point where it does become an issue? Or are the other folks saying, where else are you going to go? So no,
there's an element of that, true, Carol. I mean, but I think the US is reaching it has the ability, it has the exorbitant privilege of being the reserve currency. And there are no alternatives at this point. But you're at a point now where it's going to hurt the economy more and more. And it's
because why?
Because rates will stay higher and they're more volatile.
Okay.
Because you're going to be rolling over all this. So the Treasury is now issuing more short-term debt.
Right.
Because they got scared in late 2023 when the bond market had a bit of a mini rebellion about them trying to increase 10-year and 30-year issuance. But that means if you're issuing more short-dated debt, you're getting to a point where you're rolling over more on the front end of the curve. That could potentially unnerve investors at some point. So the US has got to get some fiscal discipline. The problem is, of course, it's very politicized. Mm-hmm. And both sides of Congress like spending money and have been able to borrow. And that's what also Moody's pointed out. It's successive administrations. This is a bipartisan problem, and it requires bipartisan solutions.
We've heard about bond vigilantes coming in, and the specter of them has been there for years. We always hear the James Carville quotation about being as powerful as the bond market. Yeah, reincarnated. That's what he wants to be. But,
so great.
But we haven't seen them emerge this time around.
We've seen flickers of it. We saw it in April when the tariffs. I think the other problem with this administration at the moment.
That's when the bond market got a little yippy?
Yeah, because the dollar's been weakening. And so you're seeing foreign investors who've made a lot of money over the last 10 years owning US assets, equities, credit, and also treasuries, have been rebalancing. The problem with this, of course, is if this rebalancing continues to become something bigger, I do think when you do talk to a lot of bond investors, they don't like the 30-year part of the curve. It's just too much duration, and ultimately you're going to have a steeper yield curve as a result.
I mean, we've seen the dollar come way down, right? If I look at just even the dollar index.
It began the year very, very richly valued, as did US equities. So you can make an argument if you're sitting offshore and you've had a really good run investing in US assets for the past decade, you should be rebalancing. It's probably time to rotate into other markets. So it could be just a rebalancing. But if you look at the numbers, the US debt numbers, the debt servicing costs, this is alarming. And I don't think anyone in Washington really, they just don't seem to be that concerned. So it's going to require a bond market vigilantism, flexing of the muscle, to kind of snap everyone's attention.
I love that you went there, because I keep trying to make sense out of stuff that was at Milken this year, of a lot of really smart investment professionals managing trillions of dollars saying, hey, listen, it's a rebalancing when you see investors start to look at Europe and elsewhere because they became overexposed to the US market. And that's what's going on. I'm trying to make sense of, is that what's going on, or is it also some concern over the U.S. fiscal position, the U.S. economic position going forward, and whether or not it's going to be different? And so you don't want to have as much exposure to the U.S., or maybe it's a little bit of both.
I think it's a question of both. It's also a question of this administration with its tariff and trying to rework the global trading system. That's a big problem too for investor sentiment. That's really unnerved people. And again, you've got a weaker dollar when rates are going higher in the U.S. That's kind of strange, and that's a signal that people are shedding US dollar assets.
I want to ask you, forgive me, I'm going to jump in.
Yeah, okay, I know.
Why should Americans care about a high US fiscal deficit? Why should they care about higher rates
I'll give you one
along the curve?
It means that tough spending choices are coming down the pipe, and it's going to be entitlements. And that's going to affect all Americans who are currently putting away money in Social Security down the road. The other factor here is that the most important interest rate for Americans generally is that 30-year fixed mortgage rate. That is now currently at a very high level. And that is directly influenced by the 10-year Treasury yield, because most mortgages in America typically get refinanced on a 10-year basis. If the 10-year yield remains in that 4.5% to 5% range, possibly even higher, you're not going to get a refinancing of your home loan anytime soon. More importantly, as people like Jeffrey Gunlick have pointed out, if we do go into another recession at some point, and you can never rule that out, then the budget deficit is going to get even worse because tax revenues will decline and spending will go up because more people will be filing for unemployment insurance and things like that. Which means he argues that you could actually see 10-year and 30-year yields go even higher because the deficit will get worse. So instead of coming down like they normally do in a recession, the long end of the curve won't. And if that 10-year remains stuck, you're not going to get that big, juicy refinancing of home loan that you normally get when you get a recession. So it does matter. It's really important. And unfortunately, one of the people I spoke to with the story said, most Americans don't probably understand or realize that the interest rate cost is now exceeding the defense budget.
Yeah.
They should.
All of that. If you missed any of it, go back and check out our podcast, because that's kind of why you should care. Not even kind of, it's why you should care.
And listen to, also read Michael McKenzie's story. It's on the Bloomberg Terminal and also at Bloomberg.com. Michael McKenzie, he's Bloomberg News rates reporter. He joined us here in the studio.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
One of the things that certainly has been front and center, and that is a call between President Trump earlier today and Russian President Vladimir Putin. Apparently it went on for more than 2 hours. We do have some headlines out of it. Curious to see, though, what our Nick Wadhams has to say about it and what he is hearing about what this means in terms of progress towards ending the Russia-Ukraine war. So let's get to Nick. He is in our Washington, D.C. bureau. He's Bloomberg News National Security Team Leader. Nick, good to check in with you. So what do we know, and does it feel like this is a step forward? It's always hard for me to kind of make sense over what is real progress.
Well, I think it really very much depends on your point of view. The analysts we've been speaking to and folks around the administration suggest that this could not have been a better day for Vladimir Putin. Essentially, what you see if you parse President Trump's truth post that came out of this meeting is a lot. He says there's a lot of forward momentum. It was very constructive, and ceasefire talks will start immediately. That goes very much against what European leaders had wanted. They had initially set a deadline for a ceasefire by May 12th, and if that didn't happen, then you would have sanctions. Their argument is, listen, you don't need negotiations for a ceasefire. You just stop shooting the guns, and then you have a ceasefire. But what you see in that truth post is, for one thing, the president does not appear to be putting any pressure on Russia, no mention of sanctions. And then the next thing he says is essentially this is a conversation that has to happen between Russia and Ukraine and no one else. And so he's essentially pulling the U.S. out of that conversation and saying it's up to the two of you. So it really feels like a very positive moment for Vladimir Putin. If he wants to play for time, he just got a really strong signal from President Trump that the U.S. is going to give it to him.
Nick, some additional information coming from IFX. The Kremlin says that Putin and Trump didn't discuss ceasefire timeframe, but they did agree to meet in person in the future. Given what we've heard from the Kremlin and what we've heard from President Trump in the Truth Post, what questions do you still have about this 2-hour conversation?
A lot of big questions. So, okay, no mention of a time frame around a ceasefire. That appears to be a win for Vladimir Putin. This has been an absolute meat grinder of a war, but he does have the personnel and the munitions on his side. So in a war of attrition, if it takes a long time, that's going to be a victory for him. The other question is, how does Ukraine stay in this fight? What does the U.S. do in terms of providing additional weapons, ammunition? I mean, the U.S. has been so crucial and sent over so many weapons systems. So if the Trump administration says we're not going to provide that anymore, we're not going to give you money to buy weapons anymore, what happens to all those U.S. systems once Ukraine uses up all the ammunition that it has? So there's going to be a lot of focus right now around timelines and around, okay, there's going to be a Trump-Putin meeting. When will that happen? Will it happen in June or July or August? Could Putin drag that out? Final question for me is, what happens to this big sanctions bill in Congress? Senator Graham, who's been an ally of the president, says, hey, we've got this big sanctions bill. It's got 80 members of Congress, or 80 senators, Republicans and Democrats alike. Let's do this thing as a way of putting leverage on Putin. Well, what happens to that? Right now, folks we talk to suggest it's dead in the water. Trump is going to have no appetite to sign that into law.
Man, it just feels like back and forth, back and forth, back and forth. So who's going to bring this, Nick, ultimately to an end? I mean, the Vatican is now saying that they'd be interested in, I guess, according to the president, in hosting negotiations to bring about a truce. But seriously, you understand these situations. Who is it that ultimately, is it President Trump that says, let's do it, and can put the pressure on Putin? Who is it that ultimately gets this thing to end?
Well, I mean, it's a great question, and I mean that's what's so interesting about this Truth Social post today, because for so long the president and the folks around him have been saying, listen, Donald Trump is the only person who can bring this to a close. I mean, remember in the campaign he said he would have this thing solved in 24 hours. Now in this post he seems to be saying we're not going to be involved in these conversations. That's going to happen between Ukraine and Russia. So he's sort of bowing out. So then the big question is, okay, well, what does Vladimir Putin want to do? He seems to have no incentives to stop the fighting. So the only way that at least according to the folks we've been speaking to, the only way you can really get him to sit up and to take notice is for the U.S. to say, we are going to join this sanctions effort and maybe go after oil and really squeeze the Russian economy in a way that the previous rounds of sanctions have not been able to do. Right now, though, it looks like President Trump has no appetite to do that.
All right, Nick, going to have to leave it there. Really appreciate you taking the time and keeping us up to speed. Once again, the Kremlin did say that Trump and Putin didn't discuss ceasefire timeframe. This is coming from IFX. But, Carol, they did say that the president and Vladimir Putin agree to meet in person in the future.
Yeah, so it's like TBD, TBD, TBD. Dates and certainty are what I think investors are looking for.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
It is today's big take. It's one of the most read stories on the Bloomberg terminal. It features exclusive interviews with Apple insiders about how Apple has been falling short when it comes to cracking AI. Here's how one senior member of Apple's AI team put it to our team. This is a crisis.
Not
and yes,
good.
that is a quote. Mark Gurman is Bloomberg News managing editor for global consumer tech. He joins us here in the Bloomberg Interactive Brokers studio. Mark, I was struck by this, just at the beginning of your piece, there's a picture of Phil Schiller introducing Siri back in 2011, and there are these thought bubbles. And it says, will it rain in Cupertino? What's the weather like today? Do I need an umbrella today? I was shocked to look at the small print and see that was from 2011, because in my view, that's kind of what Siri still does.
Yeah. Siri.
That's the problem.
That is a problem. Siri was revolutionary 15 years ago. It was amazing for its first couple of years because let's see, how do I want to say this? It wasn't great, but it was still amazing and futuristic and sci-fi and better than everything else. Then Amazon came around, Google came around, Microsoft came around, and they just blew Apple out of the water. The technology is just all legacy technology that they've been using for a long while now. For all intents and purposes, we're not talking about a Siri that's based on the same large language models and foundation model technology that you're seeing from OpenAI and Gemini from Google and, Anthropic, you name it. And so, yeah, they have fallen way to the wayside.
Well, speaking of Google, there was a big hire there from 2018 who was supposed to be the guy who did AI at Apple.
He was supposed to be the guy who did AI at Apple, and he's still the guy who does AI at Apple. That's John Giannandrea. Biggest miss was generative AI. They seem to have not seen this coming, and if they did see it coming, they did little to nothing about it. They really, I'm told, started on the generative AI path after Craig Federighi, the head of software engineering, used ChatGPT to finish some code for a personal project he was working on over the holiday break. They take this little 1 week break at the end of December. He was working on some personal software, as one does, and he figured out the power.
Some do.
Yeah, figured out the power of ChatGPT, and then immediately they set iOS 18 for 2024. This is going to be the big AI release for Apple. From a marketing standpoint, it was. They marketed it really well. AI for the rest of us, just like the computer for the rest of us 40 years ago. And okay,
we're good. Drop a little water.
Tim almost dropped.
When is AI going to fix that?
Yes. Other than the marketing, let's take a step back. In the robotics world, in the humanoid robotics world, the fundamental thing that a humanoid robot has to do is go to your kitchen, pick up a glass of water, and bring it to you without dropping it. Okay. Tim almost dropped his water all over him, so that's where I got the idea to mention this. The problem isn't so much the iPhone and the AI capabilities on today's devices. The problem is can Apple make AI that's good enough to power a robot that's not going to spill their water like Tim, right?
There it is.
And so the worry is not necessarily about the technology today, but it's the technology of tomorrow and a decade from now. And so the iPhone, its reign is going to be over at some point, but that's not really what matters here. I think that's not big picture enough. The big picture is the next set of stuff. We've seen AI already lead to the car cancellation in part. There were many other factors, but if Apple was able to get an L5 car with tip-top AI and great safety features...
Level 5 is what you're referring to.
Yep, they would have brought it to market. So, we've already seen AI cost them one big category. They were supposed to have a big smart home push this year. It's been delayed. It was supposed to happen in March. Now it probably won't happen until the end of this year or next year. The AI not working cost that. Now they're already having trouble coming up with use cases for AirPods and watches with camera and smart glasses with cameras because you need real good AI to use that. So the iPhone doesn't matter. It's everything that comes after it.
So why can't they get this right? Is it personnel? Is it culture? What is it?
Both. It's personnel, mismanagement, it's culture. Apple's wired in a very specific way. I get into it in the story. They're wired they sit down, they map out what they want to do, and then they make the investment to get there. AI sort of works the opposite. You don't know exactly where you're going to land. It's a little bit messier. You have to run a little bit faster. It's a little bit, more expensive to pull off. And so it's just a philosophical product development question, right? And so Apple has to change. AI moves so fast. There's a new AI provider or a major new AI technology on a weekly basis at this point, even more frequently. But Apple's wired to release one major software upgrade every year and a smaller software upgrade in the spring. So they're going to need to move away from that idea as well if they really want to stay at pace with the rest of the technology industry. So AI and Apple, it's just so interesting. It's like putting two magnets next to each other. They're just going to push away, right? And so Apple's going to have to change at a very core level to really be able to make meaningful change and to have meaningful improvement in their Gen AI world.
I'm thinking about this, and Mark, when you talk about Apple, and you know this better than anyone else, people, a common refrain, and I don't think this is true, but it's that Apple stopped innovating after Steve Jobs. And you can go and kind of look at Apple's share price and what has happened with investors and the way that Tim Cook has led the company. The concern that I potentially would have in a situation like this as an observer is this Tim Cook's legacy here? Missing AI?
First of all, I don't agree with the idea that Apple stopped innovating since Steve Jobs.
I agree with that. I agree with you.
No, I know you agree. If you think about it, they've basically haven't innovated or done something wholly new since the iPhone, right? Now, are we really expecting that? I think yes, to some extent, but you look at it and the iPad to the iPhone was like the Vision Pro to the iPhone, right? They're both different reincarnations of that same operating system. You put the Apple Watch in that category as well. So you have sort of the central product, the iPhone, and you just kept building and building around it and building it up into new form factors. And they haven't really done an entirely new product experience from the ground up. And so, at some point they'll get there. But right now it's about new form factors. And honestly, I'm not sure anyone would have done a better job than Tim Cook over the last 15 years or so since Steve Jobs passed away. So certainly could have they done a lot better? Yes, but they've also could have done much, much, much worse.
I want to ask you, does any of this matter? Because you write in the story, being late to a potentially world-changing advance isn't necessarily catastrophic for Apple. But there are risks in being late too.
Well, it's not catastrophic for Apple because being late implies that they're going to get there. And so, as long as they're late, it's not catastrophic. But they're going to need to get there because, like I said, they're going to miss so many upcoming technological waves if they don't master this. I said this to someone I was on the radio with earlier, and they were a little surprised, but think about it for a minute. You're going to agree with me. AI is as core of a technology as the touchscreen, right? That's a big, bold claim, right? So Apple is known for taking core technologies and pushing them to new form factors. And so multi-touch touchscreen, that's the type of touchscreen that lets you do multiple gestures at once, lets you do the pinch and the swipe.
Yeah.
That's called multi-touch. That was a core technology that allowed them to build the iPhone and the iPad. All their Macs and iPads and whatever they're releasing these days, the core technology at the heart of that are their chips, their in-house processor design. AI is the core technology that's going to enable robots, the glasses, to maybe they'll look at cars again in the future. Who knows? It's not something they're looking at right now, to be clear. And so they need to master that core technology to get to the next era of hardware. Apple's a hardware company, right? And if they want to continue making the money they're making, they're going to need to do new hardware. And the way to do new hardware is to come up with new core technologies.
But they hired this guy in
You even printed it out. I love it.
Oh, yeah, we print out everything.
Are you kidding? But they hired this guy back in 2018.
Yes.
So it's almost a decade.
Yeah,
Not quite, but getting close.
You're right, and that's unbelievable. But yeah, we're close to a decade since he's been there. You're right.
All right. So from someone who knows this company so well, I mean, how are you thinking about, or who are you watching, or what are you watching internally? I mean, the company obviously listen to you. They listen to others have conversations saying, where are you, Apple, when it comes to AI?
John Giannandrea, JG as he goes by, I don't think he's long for Apple.
Is that good?
I'm not going to opine on whether it's good enough for a person to no longer be at a company. But I'll put it this way. They've already stripped him of all product-related responsibility. They removed Siri from him.
Right.
They removed robotics from him. They're going to probably remove some more things from him. They want to squish him down to a role that's entirely focused on large language model and core AI technology research, which he's really good at. And so, I mean, if they're taking away 75% of your remit, you know, you may decide that the writing's on the wall. It's time to get out of here. I don't think it's going to happen imminently. I don't think he wants it to happen, but I think at some point a change will be made, whether it's because he decided or because Apple forced his hand. But I don't expect them to fire him. Apple doesn't do that for senior executives of that level unless you really do something bad. And for all intents and purposes, JG's a great guy. He's very well liked. He's very respected in the machine learning and AI communities.
Can he get them to where they need to be?
He can be a piece of that puzzle. Don't forget, Apple is constructed by a functional model. So you have design teams, you have hardware engineering teams, you have software engineering teams that bring together the product at the end of the day. If you dilute JG to only focus on AI research, but you have other people in charge of like AI product development, I think it's possible that that's a winning formula. But clearly, him running all of AI was not a good formula.
We only have 30 seconds left. Could Apple acquire its way out of this? They've partnered with ChatGPT, OpenAI.
Well, first of all, yes, they need to acquire as much AI talent as possible. But that's also another cultural issue where they have this cultural allergy to integrate large-scale companies. The Beats acquisition, internally, disaster. The Intel modem acquisition for $1 billion in 2019, disaster. They just have a terrible track record of taking these humongous companies and pulling them into Apple. So, you know, it's a cultural thing through and through that they need to make some shifts on. But if they resolve all that, they bring in the right people, they make the right cultural changes, it's Apple. They've got the brand, they've got the button, they've got it all.
Gotta say, I was in the car, I was doing a lot of things over the weekend, talking to Siri. I'm like, you're not bringing it, buddy.
You're not bringing it.
The worst thing for Siri for me, I'll keep this real quick, is like I like go to sushi restaurants. I'll say a sushi restaurant, and Siri asks how to get there. Okay, and then it takes me to the Japanese city the restaurant is named after in Japan. Why would you take me somewhere 6,000 miles away?
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the drive to the close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, TikTok, everybody.
Send someone for Carol. That's what I'm going to say.
What do you mean?
No, you're good. Summer Carol. This is what I like.
I know. Well, you know.
Fresh from a big graduation. Congratulations.
Couple days off.
Yeah.
It's always good, right?
A visit to a historic part of the country.
I know. And I'm really into the historic parts of our country. I don't know. It's like getting back to our roots, kind of understanding it. What?
You should have bought the meme coin, so you could have made a visit to. Well, it was going to be the White House, but
oh no,
because you're not one of the top holders.
I don't know that
so
I
then,
could have afforded it.
No, it was yeah, it was a lot of.
Yeah,
you would have to.
Speak
but
much?
You could have sold ahead of. You could have sold.
How much was it?
I don't know how much the coins went for, but I mean these were the top holders. Or I don't know how much the purses were. I guess I should say, or the wallets. I did not.
Yeah.
No, we're not allowed to do that here.
Remember the whole security issue of like who's going to be? Cause
still an issue.
They don't know who it is.
Still an issue.
All right, let's talk about the markets a little bit because still an issue is kind of where we go from here. But having said that, investors seem to be shrugging off certainly the downgrade by Moody's on Friday. Let's get into it. Ryan Dietrich is back with us. Great to have with us, Chief Market Strategist with the Carson Group joining us. Ryan, it is good to have you here with us. How do you, we've talked to you, we always give you props about the last couple of years, really getting your market calls right. It does feel like we're in a wait and see mode, whether it comes to Fed action, what we get on tariffs. Where are you on the markets right now?
Yeah, Carol and Tim, thanks for me back. I looked, last time I was on with you was April 10th, right? So that was the day after that huge rally. We sold off pretty hard, and we talked then about the idea that we could be due for a pretty big bounce. Now, I didn't think it'd be quite like this, but it's where we are. So, Carol, last week, if you were running around, missed it, We had a big up day on Monday, up 3%. Then the next 4 days, all were green. And I said, that's pretty rare because usually if you're big up Monday, usually you give some back. We didn't last week. March of 2003 is the only time we saw a week like last week. And that was actually the lows of really the bear market, if you will, from the tech bubble. And the war started in Iraq, and then they were off to the races. I get it, sample size of 1, but what we've been saying for a while now, the lows are in. I know it's pretty obvious now, but we were saying that 4 weeks ago that lows were probably in, and we still think this market wants to go higher, and we're listening to it.
Why does it want to go higher right now? I think that's still a lot of people who have looked at, the 20% increase that we've seen off those April 8th lows are saying, wait a second, we didn't necessarily get something fundamental shift except for this pause.
Yeah. Tim, that's a great question there. And listen, I think it's all about expectations. I mean, what was being priced into the market this time 5-6 weeks ago was just, almost, I'd say the end of the world, but that's what the way people felt like they were talking. And you see it, and then no, that's not the case. We just had a really solid earnings season, right? I know the consumer's not perfect, we get it, but the consumer's still okay. The labor market's still solid. All these things are why we say it was like a beach ball under the water. You release it, it goes up. Here's one thing to think about. Since starting on March 9th, they're at 27 trading days. The S&P's up, like we just said, nearly 20%, right over 19%. If you go back in history, other times we saw that much strength in only 27 trading days. You're talking off the lows in 74, the lows in 82, the lows in 2009, the lows off of 2020, and now. I mean, those were not the worst times to think, the market is telling us something, and we're just hoping a lot of people are paying attention because those were pretty solid times, and that blast of strength we've seen is not a short covering rally. It's not a bear market rally. It is kicking off again, in our opinion, another, a continuation, I guess we'll say, of honestly this bull market has been in place since October 2022.
Oh, so many things I want to come back at you with, Ryan. Yeah. Having said that, we talked with Gina Martin-Adams, our chief equity strategist here at Bloomberg Intelligence, and she reminded us, put out some research, and she says, however, while U.S. equities have been a key beneficiary of de-escalating tensions, they continue to lag major global markets in the rebound toward pre-tariff Liberation Day highs. So even though the bounce back when you go outside the United States has even been better.
No, shout out to Gina. She's awesome, obviously.
She is.
And that's true. In the money that we run for our Carson partners, I've come on with you guys for a while, for a couple of years, saying we like the U.S. We like the U.S. Honestly, starting earlier this year, we've kind of taken, we're still in U.S., yes, don't get me wrong, but we have some exposure to developed international, specifically Europe. I mean, when we saw Germany break out the fiscal bazooka a couple of months ago, we said, wow, there's something going on here. So yes, diversification used to be a dirty word. Diversification always used to having to say you were sorry. Then you have a year like this where it's like, wow, I guess a lot of investors are glad you're diversified because if you have global portfolio, you're up nicely this year, right? If you're all in Mag 7, all in US, we get it. I guess you're positive kind of now, but it sure was a long trip to get there. So listen, when you're uncertain, diversification really can work, and that's a nice way investors need to remember that.
Yeah, I mean, you're positive for the year as long as you didn't sell. I'm kind of saying under my breath.
Well,
Ryan.
True. No, I totally agree. And again, we came into this year in our outlook that we put out, in January earlier this year. Yes, we were bullish. Yes, we were optimistic. We said there could be a 12 to 15% peak to trough correction because we hadn't had one in a while. By the way, after a 20% gain, the first quarter is usually pretty weak. The first quarter of the last 20 years has been pretty weak. Oh, and post-election years, the first quarter is actually one of the worst quarters out of a 4-year cycle. So all those things stacked up that we could have some indigestion. No, we didn't see a near bear market. No, we didn't see a 10% crash after Liberation Day, but we did see the potential for some volatility. And now just as quickly, obviously, we're on the other side of that, fortunately.
Hey, though, Ryan, is it a peak to trough correction that we just needed because there was too much, fluff in the markets at this point? Or is it, the trade really reacted to the news out of the White House. It's why we talked about it so much, because you could see clear correlations based on what was coming from the president and his views on tariffs in particular. And the markets reacted. So there was a fundamental basis to it. And if the fundamental basis going forward, especially when it comes to tariffs, is that, yes, indeed, Libby Cantrell of PIMCO, who we talked to earlier, we could potentially still be in a much higher, historically higher tariff environment going forward, and that has implications for markets.
No, there's a lot there. You know, if everybody's thinking alike, somebody isn't thinking. I like to use that quote a lot, General Patton. It sure felt like late last year, everybody was bullish. I mean, these long-term bears were claiming they were bullish all the time. We're looking around as people that were taking a lot of arrows and body shots in 23, early 24 for being bullish, thinking, uh-oh. And I do think we needed that washout. I do think we needed to shake the tree a little bit. There was a little too much froth, up 74, 75% off the October 22 lows. Maybe it was necessary. And I didn't think it'd be, again, 20%. But it's what happened, and that's what shook a lot of those hands out. But you're right. You know, when President Trump won, I mean, what's the phrase? He used this. It's going to be close enough for government work. Tariff, the most beautiful word in the English dictionary. It's not like this was a total surprise. Now, I get it. When he held up that board on Liberation Day, April 2nd, those numbers were higher than we expected. But I'm not sure. I did read Libby's note today. I mean, Libby's awesome also. You know, the reality is I think markets can live with 10 to 15% tariffs. They couldn't live with what we were seeing a couple months ago because that's what's being priced in. And then that's kind of where we are. And you know, if they bring all those tariffs back, yeah, we're probably going to go right back down. But I don't think that's the case. I think we're kind of through that. And now, you know, what do we have? We've got deregulation coming, potentially lower taxes coming. Those are the things also coming the second half of this year. Go ahead.
We're now a little change on the year. What do you see us by end of the year? Do you think we'll be up 5-10%? What's your call? Got 10 seconds here.
Yeah, we came into this year, we said between 10 to 12%. I'll tell you what, I think we're still thinking that's very likely. We got a round trip, but we think it's possible.
Ryan Dietrich, got to run. Chief Market Strategist with the Carson Group, joining us on this Monday.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.